I wish folks on some level we could sell the show before the show. I think we could. We discussed a myriad of topics. Best audio performance from the 1990s. We discussed greatest Christmas crooner, which is Neil Diamond.
I think.
No, it's Neil Diamond. It's not I think. It's Neil Diamond Coming to America. By the way, I recommend highly the cover band. Now, Neil Diamond doesn't tour anymore, unfortunately, Neil Diamond. I'm a big fan, as Parkinson's. Okay, so a little sad note.
I didn't know that.
Oh, yeah, like a little sad note. We're starting the show on a down note right now. He got diagnosed in, I believe, 2018, 2019, and he stopped touring immediately. But, high note, you can go see Surreal Neil, the Neil Diamond cover band, anywhere in the country. I saw them in San Diego. Stay classic. And so I saw them in San Diego. And I highly recommend Surreal Neil.
Surreal Neil.
Yeah, and if you really want to feel motivated, like you want to feel good about yourself this weekend, whenever you're listening to this, just Google it's just America, right? From the greatest movie ever made, The Jazz Singer.
The Jazz Singer.
The Jazz Singer, starring Neil Diamond.
Neil Diamond.
Yeah. Is Neil Diamond the greatest artist ever? I mean, clearly better than Kiss because he can sing. So anyway, as we make a sojourn here into market excellence, which we do every week. Look, you're going to get a lot of Danny this weekend, stock nerds and market lovers, and that's not a bad thing. So I made the mistake of talking with Danny, which I try not to do. I just try to text him, and I particularly try not to talk to Danny on Fridays when we tape the show because I don't want to give up. I don't want to lose the spontaneity of Danny. That's the honest to God's truth. That's not me joking. Like, I want Danny's reactions to be just right off the top.
Genuine,
yeah.
Right.
And but today was a different day, and because I wanted to talk to him about a couple of things. He goes, "Well, what are you going to talk about?" And I'm like, "Oh, he's got me cornered." Like, hey, what are your topics? And so, all right, we'll do it. But which led to some further enhancements of said topics, and all of this matters. Like I'm going to give up the punchline here at the beginning, so we can get to the end. Okay.
Okay.
All of this will lead you to want to be underinvested in one particular area if you understand this facet of economics. But before we do that, there's two things I want to cover. I've talked about ad nauseum this tick trade, and I want to show you something. And it's a little hard to pick up when it's esoteric and I'm just talking about it, but it happened again on Wednesday. And a lot of people that listen to the videos, and they operate, and quite frankly, a number of them are an IPO club. And so, by the way, if you want to find IPO club, just email me or tim@reasor.com. Find me on Twitter @TJReazor, and I'll introduce you to the good folks. They're just like you. They're stock nerds that listen to our content. This is where the idea of More Danny came from, by the way. It was from
More Danny.
More Danny. We want MD. I'm sorry, MD 2020, because that's Mad Dog 2020, and that is not a good liquor. No, More Danny. MD stands for More Danny. I need More Danny. I'm like, okay, I'll go get you More Danny. You don't have to yell, which you can't even tell if they're yelling on Twitter.
I know. You need a voicemail inbox set up so we can start playing these folks on the air.
Yeah.
The impressions are good.
It's something Danny's wife doesn't even want more of because Danny self-proclaimed best driver in his family. And by the way, offends AK when she's on the speakerphone. And so, because
what?
Oh yeah!
Wow! Don't get
what's going on over here?
My wife always wants More Danny.
It's a smear campaign.
No. I've taken a poll. It's like try to gum. 4 out of 5 women want less Danny.
All right.
They want more Danny.
Wow.
No, they want less Danny.
All right. Hold on. We were talking about tick trades. This has gone off the rails.
You said tick trades. Let's just clear it up for the odd tick.
Tick trade, meaning minutes trade.
Tick.
Uber short term.
So the tick trade it's the tick fade, right? And it works like when you shoot up like over 1,000 ticks, but when you open up really low, like you did on Wednesday at 1481, hell and damnation gonna rain down on markets. Look at this down here at the bottom of your chart. You got a gap down on Wednesday morning. We're going to hell and damnation. And I want to tell you, stockers and market lovers, like 9 out of 10 times, what you want to do is take the opposite side of that trade. It's not an all-day affair thing, right? It doesn't have to work, but time immemorial, like more times than not. That's why I keep talking about it. It can produce results for you if you're just happen to be stumbling around the markets at the open. So look at this, Danny. We go to 1481. Markets are going to fall apart. And then I want you to notice what happens for the ticks. They get a little relief. They hit 1,000 again, and then you get some more relief. Now, I want to point out what happens at the bottom of your chart. This is the SPX. And so the SPX gaps down, opens lower, goes down to a low of 43.04. Close enough for government work to 4,300. Okay? But then look at what you do from 4,300. You go all the way up to 43.29. That's a big move, S&P wise.
Mm-hmm.
You can trade that move
If you have cash. You have to have cash. I mean, if you're fully invested, you're.
Oh, okay.
Yeah.
Like, isn't that a prerequisite of all markets?
Well, no. What I'm saying is you got to be pre-positioned.
I got out.
What I mean is you got to be pre-positioned with a chunk of cash to be able to push the cash to work.
Alex, I can't see any of you, but man, you're out. You're
Conversely, if you've got a massive, huge gap up with ticks, if you're invested, you can pull some off.
that.
But if you're all in cash, you can't.
Fade that. And someone might say, well, Tim, why would you just trade the S&Ps for like 20, 25 points? Because if you buy some, that's Wednesday. Mm-hmm. So you could buy some, what I would refer to as zero-dated call options, right? Because Wednesday's an expiration day for SPX. So was Monday. So was Friday. You just take a shot on one or two out, at the money, maybe slightly out of the money, zero-dated call options. Well, let me tell you something. Now you got your.
I like the idea of the call options.
Yeah.
But I actually may go out just a little bit further
go to Friday.
So that I don't have to be. I'm talking about a couple of weeks or even a month, just to give you more time to be right.
No, but there's no because you're not holding this.
Yeah, you're talking about a short-term trade.
This trade literally lasted like 20 minutes.
Right.
And so there's no. I don't think to Danny's point. I don't think there's a reason to pay for that kind of premium. Mm-hmm. You could go out the Friday. Because if the trade, if the market just started running, you could then hold that trade Thursday, But this trade works so, and the markets since the beginning of September has given you this opportunity, like this kind of volatility. So I've got that for you. So we just
before the show, we were actually talking about using weekly charts when you're talking about long term. You're trying to hold something for longer. So you really gotta define your time frame to know what tool you want to use.
Right. Okay, so there's that. But then I've got even bigger news. So Tick Trade is right there. I wanted to get it right at the top of the show. Show note, Mr. Zach. Tick. We need to use some truth and title in here. Money making trade. All right. Something that gets people excited about this because what happens is
the bigger news more Danny.
Yeah.
Yes.
The bigger news is more Danny.
Yes. 30% more Danny in this show. Yeah. Hold on, Danny. Hold on to your bridges.
Now with 40% more Danny.
Oh my gosh. Can we get that into the show description as well now with 40% MD?
Yeah.
Okay. So here we go, Danny. There's big news out. There's a new restaurant. Oh, Hunter. What, Hunter, you there?
Yeah, I'm here.
Speak to me. Hunter, come back.
Yes.
So look,
Hunter, come back.
Oh, yeah, absolutely. Boy, now I got to tell you what. According to a study sanctioned by me, mommy, 9 out of 10 women like more Hunter. They want more Hunter.
What are these 9 out of 10, 4 out of 10 women polls you have just ready to go?
I just got it ready to go. Okay, Hunter.
Made up.
I want to know your points on Chipotle. Your point total. I got 2681.
Whoa, is that your Chipotle app?
Yeah.
You got 2,861 points?
Yeah.
On the Chipotle app?
Chipotle app.
What's that mean?
I'm checking right now.
That means Tim's gained 15 pounds off the bottom of his what's that diet you're on?
Keto.
The keto bound.
Hurt feelings.
All right. So
let's just cover that. 1, hurt.
Yeah.
2, I do the salad. I don't do beans. I don't do rice.
First, Chipotle is great for keto.
Yeah.
I did keto for a year.
Yeah.
Chipotle is perfect for it. Secondly, if you don't have the app, how do those, what are the $1 a point?
No clue. Doesn't matter. Doesn't matter.
When you go there as much as Tim, it doesn't matter.
Right. Doesn't matter what. I don't even know if it's half a point $1.
Yeah. He's got his own table in the corner.
They could be shorting me points and I wouldn't know. What I'm saying is, though, they have gamified it.
Sure have.
And let me tell you something. They dropped something. They slipped into my DMs. They slipped in, you slip into my DMs there.
Yeah.
Oh, yeah, come on, slip into my DMs.
Yeah.
This is what you're talking about.
Absolutely.
Yeah, and so old Chipotle slips into my DMs and says, hey, by the way, Tim, We've doubled your points for the next week. If you just go 1 time per week for the next 4 weeks, you come on over to our little restaurant. We're going to give you 500 more points.
Wow.
Like, look at this. You know where I'm going today.
You got to get the high score.
That's exactly what I'm saying. What's your points, Hunter?
How many points you got?
I'm trying to find it. I've actually got 2 Chipotle accounts here.
Oh, good Lord.
I don't.
Oh,
know
my
if
gosh,
either one
double
is
dipping.
accurate.
Hunter may be showing up Tim.
I
Man.
know he's got. I think Hunter's got. Here's my prediction.
He's got an account for his dog.
In total, Hunter has 13,738 points.
All
That
right.
is my
13K.
13K. That's what I'm
Lord.
thinking for Hunter. So, but anyway,
You're way off.
what do you got?
Does it reset once you use your free?
Yeah, it takes them out.
You got to use them.
Got to use it.
Okay. Because I'm looking at these and I've got like 421 and 130, but I know I've gotten a number of free bowls.
Yeah, like
every
free bowls are like
basically when you get 1,000.
Yeah, you get free.
1,000
Yeah,
points and
you can get
a free bowl.
merch. You get merch. You get T-shirts.
I do have. I've got
can-
2 free guacs on both of my accounts.
Yep,
Four
they
total free
call that
guac and pesos.
you when you hit a certain level, like a high score at a pinball game. Pinball Wizard, great song by
Great
The
song.
Who. Oh, great song. When you hit high score there, what they do is they enable guac
What?
mode.
That's right, guac mode. That's true.
Yeah.
Why
I've
would
seen
you
that.
want
What?
a T-shirt?
Now here's
Yeah.
the thing.
Wouldn't you want to walk around with Chipotle branding, Tim? What, Danny?
Not
Wouldn't that
gonna
be
lie to
great?
you. I was
Yeah.
doing some iHop research.
Oh, really?
Yeah, because we do that in my house.
Okay.
And you can get a hat that says pancakes, pancakes, pancakes. And I'm not going to lie to you, I kind of want that hat. So here's the thing.
Didn't Elton John also sing Pinball Wizard? I know it was by The Who,
Oh,
but he did a version.
is there
I
a
think.
cover of it?
I think he did a version.
I think there's a pinball song by Elton John.
Oh my gosh.
Pinball Wizard.
There
It's
is
Pinball
a.
Wizard.
Have you heard the song Royals? We could be royals.
Lord.
Okay, there's a version of that song sung by a clown that is absolutely delightful. Google it while we're on the show.
I will.
Yeah, it's like he's like a tall clown. You know what? I can't direct. I wish
No.
if I don't
Yeah.
have it up, I can't.
Keep going.
Right.
Keep going.
Right. Okay.
Chipotle points. Let's get back
No,
on track.
but
Focus,
IHOP.
Tim. Blinders.
Hold
Blinders.
on.
We got an hour for the show today. Remember, we're on time crunch.
IHOP has opened a new restaurant.
Really?
It's called Flip'd. Flipped. And we need to talk about this. I would go to Flipped. So Flip needs to give me an app that gamifies eggs. And
So like an upgraded pancake.
Yeah.
well, what it is they're
Is
going
this a breakfast Chipotle?
yeah, because they're going to do. Look at these sandwiches; they look good. I don't eat bread. I'm like Tom Brady in that regard, except more handsome.
Oh, it's quick counter service.
Yeah,
it's
like
like a Dunkin' Donuts, but for IHOP.
and you can eat there. Do I not? I don't have the sandwiches here. They don't show them. You can dine in. Oh yeah, I'm going to show you this. They got some coffee drinks. I only do black
Flip.
coffee.
It's got like a cute bubbly font for the. Oh, that's
Look at these
sweet.
sandwiches,
Look at
right?
that.
Like
Yeah.
I would do those sandwiches. Take the.
It's for the younger generation.
It sure is.
No,
Yes.
this is
Yeah,
for
this
me. Eggs and bacon are for me.
Yeah, but you're a kid.
Pretty hard to sandwich.
You're a big kid.
Look at those bowls.
Pancakes in bowls. Pancakes to go.
It's literally the same bowl Chipotle uses.
All right, listen.
Some keto diet.
I'm not doing the pancakes. Stop judging me, handsome Alex. God, you thin people with biceps judge us fatties. Stop it. You're body shaming. That's why Facebook is
I got
down.
a question about Chipotle. What's up with the outside in the parking lots? There's always a burrito loading zone. What is that?
It's for to
That's,
go, I
uh,
think.
It's for the go
I
orders,
think
man.
The pickup area.
Oh, I
Fuck.
usually just park there because it's open. So,
That's because you're a body shamer.
Because you're getting a burrito loaded.
yeah,
You'll
exactly.
be in there getting one. Yeah, you're there to get
You
one.
don't park in the handicap too, do you, Alex?
Absolutely not. I actually really don't like that.
So
That
here,
bothers me.
That's not fun.
here's the thing. Now I'm going to transition. So jobs report came out. Okay, now everything I'm about to talk about with Danny is absolutely has an effect on stocks. So people might say, what economics have effect on stocks? I'll just watch the chart. There's a reason why, in my opinion, and I reserve the right to be wrong all the time, Dan. It's reserved, just like burrito loading zone.
Yeah,
that parking spot next to it says Tim could be wrong.
And you need to. And
Yeah.
You need to.
That you rarely find someone who's good at economics and stocks. Okay,
Mhm.
they're like who's the guy who
Hence more Danny.
yes, hence MD. Who looks like the number 2 pencil? Is it Mark Zandy or is it the guy from Chicago Booth School of Business? I don't think it's Mark Zandy. It's who's the guy who he was on Obama's team and now he teaches
Austin Goolsby.
Austin Goolsby
That's
looks
gotta
like the
be
top
it.
of a number 2 pencil. Like if you envision what a number 2 pencil would look like come to life, it's Austin Goolsby. So Austin Goolsby probably couldn't pick a stock out on the side of a barn if he saw it, right? But he can tell you about some economics, okay? And probably on the wrong side of the economics. But what I'm gonna explain to you, what I'm gonna discuss with Daniel, is that there's a reason why, when you understand what we're about to talk about, why future earnings of certain types of companies might be worth less. And the market is the stock market, the people that participate in the market of stocks, they're going to discount those types of companies, okay? Mm-hmm. If what we discuss is coming to fruition, and I believe it is. It's been coming to fruition. How do they discount those, Tim? They take them down in price, okay? So you would want to be careful to overweight a portfolio full of these types of companies. But I first need to set the stage, okay? Jobs report comes out. And by the way, everything I'm discussing right here on this week's show notes, you can find the show notes on the Revere website. If you watch the video podcast, you can find them on our YouTube channel. Alex, tell them what they're going to win if they go to Revere Assets YouTube channel.
Oh, you're going to catch our daily videos. We put out daily market insight videos every day. I've been a little bit delayed. I was in a process of a move and I had some issues with the new house. So I was going to put one out last night, a bonus stock video, but that's going to be delayed.
But what do they have to do for YouTube, Alex?
Sweet baby Jesus, you just told us you can't poop at your house, but you can't tell me how to subscribe, rate, and you subscribe. What is it? Subscribe,
like, share, and subscribe.
Like, share, and subscribe.
That's all I need you to do, man. I can't go to the bathroom at my house, Tim. By the way,
I had guys here until 12:30 last night jetting the sewer line. So
you had time to call me Tubby, but not tell me how to rate, like, and subscribe. Did I do that right? Is that what you do?
Yeah, so there's a big red box, subscribe button, press that. There's also a bell notification you can put on your phone so it alerts you every time we have a video.
There you go. Thoughts and prayers to Alex.
He's going through it. Hey, that big move, man. It was hard.
Look, your life is hard. You got to find ways to find laughter in some of the hard times. So here we go. Jobs decline, right? I got to look at my notes here because I want to make sure I present
big jobs miss.
But I don't. But that's not so much of the story. Okay, it's a part of the story, but it's not the whole story. All these notes are within this. But what we need to pay attention to, instead of just talking about it, I want to bring you here to this part of the jobs report right in here. It's earnings. Okay. So look at this, Daniel. Non-farm private earnings are up. Their average $30.85 in September, following large increases for 5 months. In September, average hourly earnings for non-supervisory employees are up to $26.15. More hours worked at 40.05. That's great. I'm pro worker. This is all fantastic. But we bring people a podcast weekly about the stock market. This right here is not good for stocks. Okay? Because it's not good for certain stocks. Because this is not transitory. Once you raise someone's wages to compete, to get people to help you grow your business or maintain your business,
right?
You're not going to be able to decrease their pay unless a major recession comes along, right? Like we're a COVID event where we ask people to take pay cuts because we don't know the future, which happened in a lot of companies. This pay,
or people start losing jobs. Big jobs miss.
Yeah. This increase in wages is absolutely inflation. Okay, and I want to talk about that with you. But I really think it has an effect. This type of inflation has an effect here on the TNX. TNX. Okay, the TNX let me get this off a 2-hour chart. The TNX has eclipsed the levels of September 28th, okay, which was then a recent high.
10-year Treasury rate, the interest rate.
I believe, and I've said this for a while, you're going up to 1.7. I don't think the market can sustain the move up to 1.7. And it's because rates are going up, not because of Fed raising rates. They're going up because of a couple things happening in the market that have to do with the dollar, okay? And a couple of other things. And I want Danny, people want more Danny, and they want you in here. So I'm going to ask you a series of questions. Okay. I'm going to ask you to opine on these things. Okay. So I want to talk about the dollar right here. Well, hold on a second. I should back up. When I say rates aren't going up because of the Fed, what are they going up for? Why are rates going up if the Fed's not doing it? Address that.
Well, that's.
Oh, by the way, I'm sorry. The reason why I said that, just to circle back here, most people can't put together economic events with the stock market. This is one of the rare times. Like sometimes growth stocks are just going. They're just, as Danny would say, they're going and blowing, and you want to be a part of the ride. There's a time where economics have an effect on markets in a certain group of stocks. The companies that can't pass on these cost increases. This has to do with future earnings and the devaluation of future earnings. And if you understand, they don't teach this anymore. You have to hear it. You have to absorb it. You have to read it, because they're not going to teach you this unless you're trying to pay attention to different sources and you can put it together. That's why Mark Sandy Do and the Eraser, whose name Austin Goolsby. That's why they can't combine it, and they have to bring other people in to kind of make sense of it. We can do it all here in shop. That's why we're popular. So Daniel, why are rates going higher without the?
Well, so the Fed, when they tighten, that will raise rates. Right now, they're really not tightening. They talked about tapering in the future, which is going to be really hard for them. I don't think it'll happen. But right now, it's really the market supply and demand. It's basically people are worried because they're starting to talking about passing this big budget. They've increased the debt ceiling temporarily. They're spending more money, so rates are starting to creep up. Inflation is causing rates to creep up because you've got to cover the cost of inflation. Or inflation is bad for bonds. Inflation causes rates to rise and bond prices to fall. So that's one reason the Fed now is kind of backed themselves into a corner, because it's going to be really hard for the Fed to actually raise rates without causing a recession, killing the economy. And so if they keep rates low on their own, then you're going to have inflation. So now, which way is it going to happen? Well, it's starting to cause it. There's a whole bunch of economic factors that are causing this inflation. Now, supply-demand issue, there's a bottleneck in the supply chain. That's not technically inflation, but it has the same effect. The money supply is very flush. There's a lot of money sloshing around there, and Congress is talking about spending more, and they're increasing the debt ceiling. Okay, so you now are having rates rise on their own accord. It's not the Fed. Now,
okay, let me pause you right there.
Okay.
So let me just show people what kind of the problem is factually, then we'll continue the discussion. So this was August, so it came out September 14th. This is the August read on inflation, 5.3%.
That's an annualized rate.
If you go back to the employment data and wages, wages had that big move of 0.6, but
month over month.
Right. But wages have only risen 4.6%.
Meaning you're losing purchasing power. You're taking a pay cut by 0.2%.
And so,
but here's the other thing.
1 second. And so the point to think about is, which way do people think inflation is going to go with crude oil? Let me show you this chart. See, we're going to tie it all together here, stock nerds, step by step. Crude oil making, is this like a 2-year high on crude or 5-year high on crude? Let's go back. This is a high. Yeah. It's pretty big. This high in crude oil hasn't been seen since 2018. Wow. Okay. Natural gas. We'll keep it on a weekly chart.
Well, let's just keep it real simple. All the futures are going up.
Yeah.
Energy, food cost, and by the way, a lot of those CPI numbers, consumer price index numbers, are ex food and energy, which is one of the main things you spend money on as a consumer. So, but let's talk about 0.6 was month over month.
Right.
So 5 point whatever was the annualized rate. So if you divide 0.6 divided by that 5 point whatever, it's showing you the rate of increase, how much. So the rate of inflation is starting to accelerate, because if you multiply
11%.
Yeah. So if you multiply 0.6 by 12, that's the current kind of annualized, you're really starting to heat things up, and you're starting to, and here's the other problem. Inflation can have a self-fulfilling prophecy, because in the late 70s, when retailers or even businesses, if they would buy product and sell it for a profit margin, then next month prices raised, they had to go spend more money, they had to go buy inventory to higher cost. They actually made more money on the books, on a balance sheet, by just buying and holding their inventory. So people would, and consumers would think, man, prices are going to be cheaper next month than this month. I'm going to go out and buy stuff now. I'm going to buy my stuff forward. And that makes prices rise. So it has a self-fulfilling prophecy. We know, we've heard the story about the supply chain with Christmas, and there may not be enough stuff to go around. So, hey, you ought to do your Christmas shopping early. That's also going to cause prices to get bid up. So you've got a perfect storm brewing with inflation. Now, there's certain types of stocks that can pass that along, energy, commodity stocks, whatever. Tech stocks will get hurt more than other stocks.
Let me pause you just right there, because I've got a thought on that I want to make sure that it's really abundantly clear. That's all.
Okay.
If you shop at Amazon, okay, you can delay like whatever you're going to purchase. You can decrease the whatever you're going to purchase. Like
the volume.
Yeah, you were going to spend $1,000. Now you can spend $500. You spend $100. You can spend.
Right.
But if
it's discretionary, you may not need it.
Exactly.
You need oil. You need to buy gas to drive.
And if you're going to,
yes,
exactly. If you're going to go to work, that 50-cent, $1.50 increase in petrol and gasoline, you got to get to work.
Right.
So your earnings they're not going as far. So what you're earning isn't being stretched as far. And then you take this increase in food prices. I've specifically pulled the CPI.
So you got to buy food.
Yes.
You got to buy gas.
Yep.
You got to buy drugs.
Yep. And this is what you at home. What Danny just said there is so important. So, and it's not understood. Like Amazon is when I say great company, ethically, I don't know. I don't want to comment on that, but they're selling a lot of goods.
Right.
They're moving a lot.
You got to separate a good company from a good stock.
Right. And
Wall Street and Main Street.
And when you see the deterioration on a chart, now you can tie this together. Like a lot of people and these are very esoteric concepts. And what we're doing here for you is trying to make it simplistic, so you can understand it. And then if you can understand it and then explain it to somebody else, that whole circle of education and empowerment that we believe in here at Revere continues on. And so this is the thing. Instead of, a lot of people will do this, and you'll see this on Twitter. Like if somebody famous, and the people argue stocks. I don't want to bring up specific people's names. People argue stocks, and like they'll argue Amazon's a great company, or Google, everybody's using Google. Nobody doesn't not use Google. I get you, but they're going down. Okay, so when they break trend, and they break like the 21 is the one I really focus in on. That's typically a shift in trend. And if they're doing that, and you have this other piece that we're discussing right now, you get an understanding of why and what it does. Now, here's the action part, because it's not just an esoteric nature that we need to talk about. It's the action part. You don't buy these stocks until they hit maybe a certain level, maybe a 40-week or a 200-day, right? Like, or you just stand clear until...
Meaning they pull back enough to become cheap enough to make the value.
Yeah.
So let me put this another way that people may understand it, especially for people that are more longer term than we are, because we make adjustments quite frequently. But the CFA Institute did a long term study, like a 40-year study, and they took a baseline portfolio. They took a portfolio of 50% stocks, 50% bonds. They used that total aggregate bond index. Back then it was Lehman. Lehman's bankrupt now, but in 2008, but they took the aggregate bond index and the S&P 500, 50-50, right? And that's the baseline. And then they carved out 20%, 10% from each side. And so you had 40% stocks, 40% bonds, and then 20%, and one was real estate,
right?
One was 20% private equity, so 40-40 in private equity. and then one was hedge funds, and one was precious metals and commodities. And over that long time period, okay, not only the best performing portfolio on total return, on highest return, but based on the Sharpe's ratio, which does return divided by risk. So it's basically it's a risk adjusted return. What's the best value for your money? Was the precious metals portfolio and the commodities portfolio. And then second was real estate, and private equity and hedge funds were way down the list. And that's because private equity and hedge funds, most of them are either based on either the bond market or the hedge fund bonds, bond hedge fund or a stock hedge fund. And they were highly correlated stocks and bonds. So many times, 5-10 year periods, the stocks and bonds did great and the precious metals didn't do that well. But during the 70s, because 70s was included there, when you had a high inflationary, stagflation environment, stocks and bonds both got creamed, with the exception of energy stocks and some of the stocks you're talking about, Tim.
Yep.
So bonds, inflation is like kryptonite to bonds. So people that have a 60-40, balance fund could be setting up to get, crucified coming up if this continues. Now, so the point being is, if this scenario, and by the way, I'm not a homer for gold or precious metals or commodities, because during the 80s and 90s, once we killed inflation by raising interest rates so high, and you had dropping rates, they were a terrible investment for 20 years. Mm-hmm. But it's the time you really need them. Now, I'm not even suggesting you do the 40-40-20. All I'm saying is there's times to overweight in certain sectors and underweight in others, and vice versa. Last year, it was all about growth stocks. All about growth stocks. This year, that is probably changing. It, they've been very choppy and difficult. And going forward, that may continue to change. We'll see. So here, let me finish.
No, okay.
So inflation and it continuing with rates rising a little bit, trying to kill it. Because remember, the Fed does not want rates to rise too high. It'll kill Congress's aspirations. And then what's his name Jay Powell will be out of a job. So they'll try to put a tamper on it, on interest rates, which will hurt inflation, make inflation go even higher. So if you have this inflationary cycle, right, that's going to be one allocation you should have. However, on the flip side, if they're able to contain inflation, which is going to be very difficult, or they make rates drop, or quite frankly, Congress screws up so much that they cause a recession and they get people without jobs, you could actually, have inflation subside just by going into a natural recession. And that's a different portfolio.
That's a bad. Okay, so the one way to ease inflation,
kill jobs.
Kill jobs.
And by the way, that jobs report missed by like 70%. It was a big miss. But the room for error is pretty high too.
It is. But here's the thing. I believe that this COVID excuse is getting. I could be wrong.
Getting old.
Well, I don't know about getting old. It's immeasurable how many people are not. The workforce participation rate is low, and obviously, because
you mean they've taken it down?
It's down. Like we want a higher participation rate,
yes,
and it's not happening. And
what I'm saying is they adjust that. It used to be like 65, 68, probably 60.
I mean, unemployment is under 5%. Like before, that used to be the bread.
The only way unemployment's under 5% is they shrunk the participation rate.
I know.
The way they count.
But that was the Mendoza line for Jay Powell.
I get it. But if you believe unemployment is under 5%, you don't understand economics or how they manipulate the numbers.
I got you.
Ahead.
Okay. So the Fed raising rates won't fix supply chain issues, won't fix.
Oh, absolutely.
The Fed raising rates that won't fix, in particular, what I believe is the biggest cause of this inflation, wages. And we've been talking about this for over half a year now. That the transitory nature of wages isn't transitory at all. You're not going to once you start somebody at a salary and if you took it away, they're going to go to the place that's offering them more. That's happening. And these are just wages. This does not include the cost of benefits. And those benefits don't just have to be health care. They could be education benefits. They could be child care credits. They could be transportation. There's a lot that goes into a benefits package, not just health care. And that's an added expense. And you're seeing benefits extended everywhere from McDonald's that didn't used to do this, Subway, individual Subway franchisees, and to the normal ones, they've increased them. Chipotle and Starbucks, great payers, and Costco as well. And so, what I want to talk about, Daniel, is the natural tightening. I mentioned this on Thursday night's video, which you can find on our YouTube channel. Just search Revere Asset YouTube on YouTube or Revere Asset Your Money, and you'll see it. I mentioned that the dollar going higher is natural tightening. Okay.
Oh yes,
but I don't think I did a very good job of explaining that. And I want to show. Let me show people the dollar one more time. Okay. On a day. By the way, let's get some perspective. Right. Here's the dollar on a weekly chart. Clearly lower than in 2017. We've been in this race to devalue our currency with Japan, with
race to zero,
the euro. Now the UK is back on their own. Like we need, and it has to do a lot with exporting. But now let me show you on a daily chart. Right here. So this is what you want to understand before Danny explains this natural tightening phenomenon. That's a pennant. That's a bull flag, right? And if the dollar breaks higher, it probably does it, in my opinion, in concert with rates. And that probably has a detrimental effect on stocks. But now, because the Fed still hasn't tightened. The Fed hasn't stopped buying the level of bonds. Mm-hmm. They haven't done anything.
That's why I'm saying this is market action. Free market action, not the Fed.
But 1 second. So why is this natural tightening?
Well, so let's look at cause and effect, because it's not really the dollar strengthening that's causing natural tightening. It's the you got it backward. When interest rates rise, that causes the dollar to strengthen. That makes the dollar more valuable. You're protecting the dollar. When you devalue and you take rates to zero, it makes your currency weaker. Now, everybody thinks that, that helps exports. And yes, it does in the short term. But a stronger currency actually is good for long-term health of the economy. In the short term, it's a little bit of a booster shot. It's like taking a steroid shot or a B12 shot. It gives you a little boost at first, but it really wears off after a while. But the Fed loves using that. It tries to give free money, and then they don't do it. But rising, and then they never tighten when they should. So they continually devalue the dollar over time. Devalue the dollar is just another way of saying inflation. Okay, now, when rates rise, that makes bonds a little bit worth more. That makes, your bonds that you already own will go down in value a little bit, but a new buyer of bonds, you get a higher rate. It makes it more attractive. Okay, the dividend or the interest rate is higher. That's the bond yield. It also strengthens the dollar, but rising rates causes the cost of borrowing to go up. So it starts hurting certain deals, certain business deals. Just like when you refinance your home or you go buy a home, right now, the lower interest rates have caused asset prices to be inflated, right? So yeah, you're paying more for a house. So yeah, you can get a 2.5%, 3% fixed, a real low interest rate, but you're paying $100,000 or $200,000 more for that house. When rates rise, now you may not be able to afford that mortgage payment because the rates are starting to kill off certain people that have lower credit quality. You got to have better and better credit. So as rates go higher, it will slow the mortgage market, the real estate market, the housing market. It'll do the same thing in business. It's exactly the same thing. And so the cost of capital becomes more. So interest rates rising will slow the economy, but it strengthens the dollar. Both of those are bad for stocks. Most stocks.
And so more buying power for a consumer doesn't sound like a bad thing, but if inflation is outpacing, if the cost of the things that you're consuming every day
is going up faster than your increased wage, then you're losing money. You're losing purchasing power.
And the value of that dollar. You're absolutely, what Danny just said, losing that purchasing power. And then again, the Fed hasn't done anything yet. So when you have market forces doing this, just when the Fed comes in and increases the money supply, that's the Fed doing that, and that's great for assets. It's great for stocks.
It's great for asset prices. Yes.
Yes. When natural forces come in, or the Fed come in, and they start tightening, which we just discussed, was a tightening discussion that we just had, folks. You can see the effect right now. The markets are kind of they're a little bit woozy right now, right, Danny? They got punched. It's like Frazier Ali, right? They got punched a little bit. They're both a little woozy. And to say that this is going to take down the market and it's going to be shambles, I don't believe that. I believe, though, you're going to see pain probably into the end of October. And then, well, why, Tim? Why is there pain?
Well, let me comment on that. So so from an economic forward-looking vehicle, 6 months, 9 months out, the market should be getting kind of soft or maybe pulling back because a quote, it could be fully valued or slowing.
Right.
Okay. Now, on the flip side of that, the bullish argument, the Fed does not want the economy to slow. It doesn't want the stock market to falter. So basically it's got a Hobson's choice. How do you keep inflation in check and keep if you kill inflation, you may hurt the market or the economy. So how do they do that? But if rising interest rates or the stronger dollar start to have that effect and start having the stock market, or even more important, the bond market, because they really care about the bond market, start to sell off, you will see them reverse course and start buying bonds and stock. They'll start supporting the market because, number one, Jay Powell doesn't want to get fired. But number two, they're going into this. They just don't want to. So that's really the yin and yang of it. Who's going to win?
And so let's add one more facet into it. Okay, a couple more questions here for you that I want, or topics. Why does the debt ceiling matter, and what effect does that have on rates?
Okay. Well, so the debt ceiling matters because you want a parent at home. Look, they talk about this stupid $1 trillion coin, and Larry Summers is a moron. Okay. Oh, we could just print $1 trillion coin and just pay for it.
Hold on a second. Why would printing $1 trillion coin? You got to explain it. Why would people?
You're printing funny money. It's fake money.
Well,
okay.
This is a serious.
No, I'll explain it. Okay. There's two legitimate ways a government can get money, spend money, or pay off debt. Number one, they can borrow. Okay. Or number two, they can raise tax. They can get it from tax revenue. Whenever you hear the word revenue, that's your money. It's your tax dollars.
Right.
Okay. So those are the two legitimate ways. The third way, which is not really, up till about 30 years ago in real economics classes, they don't teach us anymore. They in the forward to the book, it used to say monetization of the debt, meaning you just print more money and stick it in the system, is the death nail to a currency, to an economy. Okay. Now, so if you've got $1 trillion worth of assets, you got $1 trillion of dollars backing those assets, right? That's fairly stable. Now, if you just print another $1 trillion and stick it in the system, now you're going to bid up the price of those assets because there's more dollars chasing the same amount of assets. You didn't create anything new. You didn't create a service or a product or growth. That's in the simplest terms, that's what real inflation is. True inflation is only monetary. It's printing of money and sticking in the system. It's not the bottleneck of the supply chain. That's supply and demand. It has the same feeling to you and me because prices go up. But by the classical definition, inflation means they print money and they just stick it in there. And so you're devaluing the currency. Now, if you let hold on, I'm going to hit that. I'm going to hit the debt ceiling.
No, 1 second. If they minted.
Well, mint. What
this
is
$1 trillion
potato?
No, I wasn't. This $1 trillion coin. What would that do to the dollar?
Well, and it really doesn't matter when they say print money. It's all digital now anyway. It's all.
If they made
it would devalue the dollar. It would make interest rates rise because it makes our currency, our bonds, quote, less. Are they now? They still AA or AAA, or are they single A? So they're going to get a credit downgrade. Okay, but to make it real simple, why not just print $1 trillion coin? That's like me and my wife saying, you know what? I owe a bunch of money. I owe $30,000 on my credit card. I'm just going to write a check out of my joint checking account and I'm just going to write a check for $30,000, hang on, and pay off my Citibank card. Now, I don't have $30,000 on my checking account. I only got $1,000, but who cares? Let's just write a check.
Stored bucks.
Yeah, that's what
You're
I'm
going to
saying.
pay them in stored bucks.
Yeah, it's fake money. So that's the reason. So
why does the debt ceiling matter?
Because if you just take away the debt ceiling and they have carte blanche, now they can spend as much as they want. There is no hamstring. There is no check. There is no parent at home. Okay. And they can go nilly-willy. It's almost like going out of town and saying to your 16-year-old son, "Oh, you could have a party here, but no, don't get wild, no drinking, no, whatever." It's crazy. So you want to have some kind of, do you know that they haven't done a balanced budget in years? They're required to every year, not a balanced budget, but at least issue a budget. They're supposed to do it. They've just been doing, what do you call them, temporary bills, add-ons every 3 to 5, 6 months. They've been doing that for years.
Right.
They haven't done a real budget in years. So the whole reason that matters bigly. That matters. That's important to have a debt ceiling to make them come back and beg to try to raise it each time. At least it keeps them in check somewhat. And, it's kind of a big facade because they raise it whenever they need to anyway. But at least it slows down. It's got some speed bumps.
Right. And so someone who doesn't traffic in all this type of information might say, well, just get rid of the debt ceiling. This makes it like it's a facade, right? Like the debt ceiling is a facade on spending.
Well, but it makes them have to come up with, so like this reconciliation, they got to do this $3.5 trillion bill, right? This big spending bill the Democrats want to push, and I don't care Democrat, Republican, they're all a bunch of thieves in my opinion. But the bottom line is, if they do that, they've got to have some kind of reconciliation, and they got to raise enough taxes from enough people, and you can't tax the rich enough to pay for $3 trillion. So it starts trickling down, and all of a sudden, mainstream people go, wait a minute, well, and they start calling their congressman, and so it adds a little bit of, it makes it tougher. It slows. That's what I meant by speed bump.
Okay. One last topic here. So remember the passbook savings from the 70s, early 80s, where you're getting 10 compounding. So why can't the government just issue like a new type of savings bond, except like we'll call it a James Bond. By the way, how was the new movie, Zach, James Bond?
Yeah, so I went and saw James Bond last night, the new one.
Was it good? I want to see it. So tell me, do I want to see it?
Do you like Daniel Craig as Bond?
I don't know.
I think you'll like it.
Okay, great.
Yeah.
And that's like an official review. I think you'll like it. I like that. I think you'll like it.
I'll tell you what, it's 2 hours, 43 minutes.
Did you have to get up and pee during?
I didn't.
Okay.
No, I made it the whole way.
That's a good.
Yeah, I was good.
Did you see other people tapping out?
A few.
Yeah. Was it sold out?
Went to Alamo Draft. If you have the means, go support Alamo.
Yeah. Geez, Danny's giving me the high sign.
Well, I want to get the Donald. Remember, we're a hard stop this time. We're at a hard stop this time.
What you didn't see on camera was Danny going, more me.
More me. No, I didn't. I want Don and Hunter and
I'm going to get to
Alex.
I'm going to get producing the show right here on the air. Can we do a MD 2020 bottle next to Danny for more Danny?
I don't know if I can put it.
No.
Okay, I just wanted to throw that out
there.
I
don't know how you will take that.
Well, why can't we print a James Bond where that James Bond will give us 7%, like something like reward the savers that have been wiped out in this economy since 2005, right?
Well, then you just raise rates to 7%.
Explain that. Explain.
So if you've got a government-backed.
Because hold on a second. Because if you issued a bond,
I'm going to explain it. Let me explain it. Quit interrupting. Let me explain it.
Okay.
There you go. Thank you. Well, you ask a question, then you try to answer it yourself.
No, I wanted to make sure.
Seven. Look, if you issue a bond at 7%, it's government backed,
right?
Or a savings account that's government backed, whatever it is. If it's government backed, and you can get 7% for that, everybody and their mother is going to sell their 30-year Treasury bond that's making 2.5% or 3%. Or whatever, and they're going to buy the 7% bond. You just in one single move made rates go from 3% to 7%, and you're going to absolutely cause havoc in the bond market, the stock market, the whole thing. That's why this engineering by the Fed and Congress almost always ends badly in the long term.
There you go. Okay, that was a lot of Danny, and that was good.
That was good.
I thought it was good.
Thank you.
Hunter, What you got, brother?
Yes, sir. I got a few things, but first, just to circle back here, I know we're running low on time. When you say free market forces are pushing interest rates higher, essentially what that means is there's less buyers for treasuries and more sellers, right? So, and innately, that pushes the rates higher on a bond. When the price goes down, yield goes up. I just wanted to clarify because you guys mentioned free market forces and this, that, and the other. So, to that point, and then secondly, going back to the 70s and 80s, or even looking at 2000, that we're in a different scenario in the sense that there is nowhere to make risk-free money. So where does money go? That's the million-dollar question. There's nowhere to put your money. You go make a 1.5 on a treasury. If you pull out of stocks, I mean, in 2000, you could make 4, 5, 6%. In the 70s, you could make 7, 8, 9, 10%. In the 80s, same thing, 10 plus.
But in the 70s, inflation was 12%. But in the 70s, inflation was 12%. So there was no risk-free in the 70s either.
But I mean, at this point, the treasury yield is what? The 10 years 1.5, and where annualized inflation is 6 or 7. So my point is there's really nowhere for money to go to keep up with inflation at this point.
Oh, there's some place. There is some place for this money to flow. I'm going to cover to my one last thing. Go ahead, Hunter.
But as far as so I've got some of the same stocks I've been talking about. You don't have to pull up every chart, Tim.
Okay.
But LNG is the energy company I've been talking about. It continues to act well. It's kind of respecting the 8-day up here. At least it was. I don't know if it's still above it. I know it's pretty close.
It's above the 5. Yeah.
Two of the strongest, actually maybe the strongest, is FANG, and it's really this oil and gas exploration group. I mean, you can see FANG is up 3%. They were up 4 or 5% just a little bit ago. So keep an eye on FANG. Keep an eye on MTDR. They're massively extended, but their strength is incredibly persistent. In bank world, SIVB continues to act well and look like a leader in its space. It's been digesting the move and broke out about 10% above previous all-time highs. But SIVB and WAL are still two of those top names, and both of those continue to look fine in the same way that the oil companies do. And then also the chemical agriculture names I've been discussing, Nutrien, NTR, CF, MOS, all of these names continue to act well, respect the 8-day, and are moving at new all-time highs. So those groups continue to act as you would expect them to act, being some of the strongest while the market was pulling back. However, I do have some different names here. We'll run through these very quick. Datadog being one, Tim, it's DDOG. Mm-hmm. And the reason I bring this one up is it's currently right on the 21, give or take maybe, a little bit there. But this is just one of those names that actually held up pretty good while the markets were not, and is sitting right on the 21. So one that's actually at a decent risk reward spot at the current juncture. Also Upstart, Tim, UPST. This was one of the strongest stocks in the market for quite some time, and obviously it still is, but one that's actually not too far off the 21 itself, started to consolidate, bounced off of it initially. And then another one in the similar space to Upstart is LC, Lending Club. This one had a big move up yesterday, and basically since then has filled the gap back to the close on Wednesday and bounced really nicely today off of the kind of the 50 and the 21 and the 8, all like curling and starting to hook up on this LC here. And then just a couple more here, Tim. CELH, Celsius. I know we've talked about it before. This is one that's held up really nicely while the market was not as well. Just a little bit above the 21, actually currently right on the 8-day exponential. Has tried to get through 100, I think, 3 different times. Not quite been able to really do it so far. And then MRVL, Tim, this is a semiconductor company that just completed an acquisition of, I believe, Inovio, which is a cloud and edge data center type of company. Somehow that applies to their business model. I don't know the full scope, but this one is just sitting right on the pivot. It's right around 64-ish area was the previous high here. So keep your eye on this one. And then the very last one, LOVE. This is a furniture company.
Lovesac.
Another chart that's acted well while the market hasn't. This one's sitting right above the 8. Not too incredibly extended off the 21. So just trying to provide some constructive charts outside of oil and gas, banks, chemical agriculture. because there are still some that look relatively good and some that have started to look a little bit better over the last few days as well. So that's all I got today.
Perfect. Alex, what's up, brother?
Hey, what's going on? I got a couple names for you.
Mm-hmm.
If you could pull up DOCN.
DOCS?
DOCN.
Thank you.
Yeah, so this during this pullback has held up really strong, and it held its 21. And this is a name. It is software, so they are a little bit more volatile, but it is a growth stock. It's newer. They kind of are a one-stop shop for storage, and you can look them up. It's kind of you have to read in on it. I still am having a trouble grasping exactly what they do because I'm not too versed on the software space, but I'm trying to read more on this company. And when you see a company that's at stock, it's at 52-week highs, and 88.48 is that high. I mean, that's telling me the market right now, to me, is signaling that there's leaders, there's potential that maybe this is just a pullback. I don't know. I'm not trying to predict. I'm just following these charts, and they're screaming at me. The other one I've talked about for 3 weeks now is Affirm. Now, this is it's been a hard one, and I'm going to defer to the weekly because we keep looking at the daily, and it's going to shake you out. So if you pull up a weekly, it's a lot easier to grasp that what is happening. And those 3 weeks there were just, I think that might be the 4 or the 8 EMA on a weekly, that purple. That might be the 4 week.
5.
The 5. Okay. That stock is telling me that this could be the new leader, the one that's gonna, bust out. Now, if the market gets hard, and I say choppy or goes down, doesn't matter what you own, it's going to come down with it. Like, you could buy the best stock of all time, and if we go to a correction, most likely that stock's not going to survive. But this stock is like DOCN is near 52-week highs, which is 146.90. You can see that on the left. I like these two names a lot. Now I'm going to show you another stock. And this is more of a story play. And I think I mentioned it 2 weeks ago. It's Dutch Brothers, BROS. Now, this came down hard after a nice little pop. You can pull up the daily. It might be a little easier. This came up to 60 from 32 at the open on the IPO day. And I'm seeing kind of like potentially a bottom here. And maybe it bases out. But this story, they're only in 12 states. This reminds me of like a Starbucks. In the early stages of a Starbucks, and this is way better. Maybe I'm biased. They have it out here in Arizona. I don't know if you guys have it where you're at, but I like this name. This is something to add to your list. And just a heads up, if you do buy something like this, you can't treat it like the other trades, because this one, because it's newer, is gonna shake really hard. So if you use a stop, I wouldn't use like a 4 or 5% stop. You're gonna have to give it some room, like maybe 10% stop. And if you do that, that means you have to use a lot less size, because you're not going to buy a lot of stock and then take a 10% hit, because that's going to really dent your portfolio. So try a smaller size, nibble at it, and watch what it does. I like that name too for a longer term play, Dutch Brothers.
Awesome. Is that it?
Yep. That's
perfect.
It.
Don, what you got, man?
A couple things. First, can you bring up the dollar and the TNX on ATR charts, please?
Yeah. It's dollar first, daily ATR. Go ahead.
So, yeah, that pennant, very clear, and it's doing it above between the first and the second ATR. So, a little bit extended. If we pull back, that 21 area is right at the top of that prior cup that formed. So, a little pullback there would be beneficial to the market, but whether or not it holds is a different story. Can you go to the TNX now? Same chart.
Mm-hmm. There we go.
Even more extended. And the 21 now is above that breakout area. So, yeah, this is getting to what Dan alluded to before about the 50-50 portfolio and the 60-40 portfolio. The traditional advisors push the 60-40 portfolio because bonds are supposed to act as a hedge against stocks. But in a rising interest rate environment, your net asset value of your stocks and your net asset value of your bonds are not going to offset each other. There's nowhere to go, and that's where commodities come into the play as another place for money to flow to. Dan, is the traditional 60-40, you think, just something that got popular because of the the long-term decline in interest rates since the 70s?
Well, so that's a great question. Since 1981, interest rates dropped all the way through 2000, before even through the tech wreck, but up through the tech wreck, and that was the longest stock market bull market in history. I mean, you had the crash of '87, but it was back even by the end of the year, so technically that bear market got broken there. But bonds had a huge long-term bull run, and Don, don't forget, inflation is actually worse to bonds than rising interest rates. So you've got a double whammy right now. But to answer your question directly, one reason they came up with the 60-40, I hate to be negative, but because it was very simple and easy to implement, it's like a pie chart. You just buy the 60, buy the 40, and move on to the next client. You're really the product, and they're selling you a packaged product. Because remember, those had commissions and 12B1 fees and trailers. So they put you in a couple mutual funds, and then that was it. It was very easy. It was a very better approach, and it was very easy to do that. A much better way to do that is, say, in the early 80s, buy a nice portion of stocks, but also bonds. And you'd even be top heavy in bonds with rates at 15, 16%, because you had big capital gains in bonds as much as stocks even. And so the risk reward was much better. Then as you get to the opposite end of the interest rate cycle and they start going up, your bonds are all selling at a premium. You've got big capital gains in those bonds. Go ahead and take profits and get out of the bonds and move to something else. And that goes to the point, Don. It, depending on where you are in the cycle, really will determine the asset categories. And commodities and precious metals are they were considered like alternative investments, like weird and different. And so the Morgan Stanleys and the Fidelities of the world, they didn't really offer them in their portfolios. So now you actually have ETFs and funds that have commodities, that have precious metals, that even have Bitcoin or Ethereum. And so you've got a whole lot more choices than you used to. But to answer your question, it was very simple and lazy. I mean, I hate to tell you that, but that's the reason.
Okay, what else you got, Don?
The 2121. So we had the list was rebuilt last week with a bunch of things getting stopped out. And with Monday's gaps down, I keep track each day of the week of what possibly could fall off the list. And 8 of the 21 would have closed below the 21 on Monday. But pretty much most of those, except for 1 or 2, have come back. So we'll review that on Friday night on the video. Key levels to watch on the S&P 500. Right now we're trading at 4,400 on the S&P as of 12:45 Eastern time on Friday. If we get above 44.39, that's where the 50-day moving average is right now. That's the most bullish scenario for the market. Under 44.39, but above 43.97, that keeps us above the 21-day, and that's we're still in pretty good shape there. If we break 43.97, but we stay above 43.75, that's kind of no man's land right there. That's the market trying to figure out what its next move is going to be. And then there's a big range, 4,300 to 4,375, that we've been trapped in for about the last week and a half. That was the big consolidation. Now we start to really get into trouble if we would break below 4,300. And then the downside targets for there would be 42.65, which is the 150-day moving average, and then 41.55, which is the 200-day moving average. So those are the key levels from high to low. Most bullish above 44.39, and below 4,300 is when we would significantly get in trouble. Now, with the gap up that we had on Thursday, that got us back above the 21 and back above the recent consolidation. We took our hedges off and increased exposure. if we stay above that 21-day exponential moving average, that's about where we're going to hang out until we get back above the 50, and then we can increase our exposure some more. But if we break right back below there, and especially get back below 4,300, our longs will be severely curtailed and will be at a beta of about 50% of the market or below.
Okay, is that all?
That'll do it.
All right. And by the way, stockners, you want to find Don's video, just go to your asset management, daily market insight, and all those levels that Don talked about. You can go over those again and give you even more information. Just hit daily market insight on the tab. Danny, I've got one more thing, but first, take us home.
All right, folks, listen. The one takeaway today, the main big overall reaching takeaway today, you need to watch bond rates and the dollar, the strength of the dollar and interest rates. Those are going to be key going forward. That's the biggest correlation to the markets right now. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. They can sign up for our daily market insight video. And they get this podcast directly in their inbox along with our daily market insight video any day the market is open. We won't spam them or reach out to them in any way. It's up to them to reach out to us if they want a complimentary portfolio review or simply have a topic they'd like to discuss on air with them. You can email us, any of us, Dan@revereasset.com. That's me, the good-looking one. Don at revereasset.com. Tim, Alex, or Hunter at revereasset.com. And you can always call us old school at 855-REAL-WEALTH.
Listen, where's money flow going? I think you said that, or someone said about where's money flow going. And look at this in terms of money flow and just Bitcoin. I want to just highlight a couple things here. So on a weekly chart, what you saw happen was I'm going to tell you the weekly mean matters, but look at where it extended to. And I think again, I could be wrong, these little tails here, right? These last couple weeks here, that's what's going to probably happen to S&Ps if we're on the plane that we're on right now. We're on that plane. And you covered all the reasons why. Mm-hmm. And so, but these tails then come back and they find support at the 21. And now you've got this move from 42,000 level, it was around that 42,000 level, and you're encroaching on 55,000. Mm-hmm. But these levels matter. And so, where's money flow going right now? Yeah, it's going to Bitcoin and it's going to ETH, and it's this Ethereum. And the Ethereum to me is a much more bullish chart than Bitcoin. I like Ethereum.
You got to position size accordingly though, because they're highly volatile and they move
1,000%. And you're at the +1 ATR right now on Ethereum and on a daily chart. And real quick, Bitcoin is at the third ATR. So, and you're already consolidating the third ATR. So just know where you are in time and space, or as they call it, where I come from, situational awareness.
Folks, we'll talk to you next week on Your Money.